This video will walk you through decision-making process for managers, which includes incremental or differential analysis. When managers make decisions, it is one of their basic functions that they perform. To be successful in decision-making, managers must be able to tell the difference between relevant and irrelevant data. And we'll discuss in a moment the difference between the two. And they must be able to correctly use relevant data in analyzing their alternatives. Incremental or differential analysis involves business decisions where there are choices among alternative courses of action. In making these decisions, management ordinarily considers both financial and non-financial information. The process used to identify the financial data that change under alternatives is called incremental analysis. Incremental analysis involves not only identifying relevant revenues and costs, but it also determines the probable effects that your decision will have on future earnings. So, for example, if you have two choices, I have a choice of renting a building or buying a building. I'm going to look at this relevant information in respect of revenues that will be generated from either decision and their cost, and the one that gives me the greatest change, positive change in my net income or future earnings, should be the choice I will use. Data for incremental analysis involves estimates and uncertainty. When we talk about cost and revenue, we want to focus on what we call relevant or avoidable cost. This cost differs between alternatives versus what we call irrelevant or unavoidable costs. It's costs that can be eliminated in whole or in part by choosing one alternative or another. So, for example, let's say alternative A is to lease a building. Alternative B is to own our own building. And one of the costs that we know we have under each alternative is utilities. Whether I lease the building, and let's say the buildings are the same square footage, so the utility cost will be the same whether I lease it or own it. Let's say it's going to be $30,000 a month. Well, since their cost does not differ for utilities under alternative A or B, the difference is zero. Because of that, we eliminate this from our incremental analysis because it's just an added step. It's not going to make a difference on decision making because if we choose A or B, utility costs will be the same. So utility cost is not a piece of information that's relevant to our decision making. We want to focus on relevant revenues and costs where it differs under these alternatives. And that's the key. So I try to summarize what are the steps for incremental or differential analysis. Well, the first thing we want to do is when we read the information, we want to eliminate the costs and benefits that do not differ between alternatives. So this is what we call the unavoidable cost or irrelevant cost. And that's going to be sunk costs and future costs that do not differ. Then what you're left with is the remaining costs and benefits that do not differ between alternatives. This cost that remains is called the differential or avoidable cost because, for example, if alternative B has a certain cost that we will not incur under alternative A, that's going to be what we call relevant cost. Oops. And it's relevant to our decision making. So let's say we're talking about shipping. Okay, just making up. Under the current alternative, we don't have any shipping costs. But if we use the second alternative, we'd incur $20,000. Well, that's a relevant cost then, because the cost differs under each alternative. And what we have here is a column. It's called change in net income. And this format, this 4-column format, is what you will use in all the business decision making that we do in this chapter. Namely, you'll have items, whether they're revenue or cost, that you look under each alternative, and you'll put down what is its current revenue or cost under each alternative. And then you take the difference between these two alternatives to say, how would it change my future net income? And this is always talking about future net income. So if this is shipping expense, that's a cost of doing business. If I choose the new alternative, I'm going to incur $20,000 of expenses that I didn't incur before. Well, that's going to do what to my net income? That's going to decrease my net income. So if I choose this alternative, I better have new revenue that's going to offset that, and hopefully even more than offset it, that I have actually new revenue that I wouldn't have under the old alternative. And you'll see this better when we do actual business decisions and we walk through information. But the key is, no matter what business decision we're doing, you have a column of 4 pieces of information. What items, revenue or costs are we talking about? What's the current alternative? What's the new alternative? And how does those two alternatives differ in revenue or expenses that changes our future net income? So to help you understand this even better, let's look at an example. In this incremental example, we have Brooks is considering a plan which is estimated to have sales of $40,000 and cost of $15,000. The company currently has sales of $37,000 and cost of $14,000. Instructions say compare plans using incremental analysis. So what we want to put here under items is each of them are going to have a certain amount of revenue. They're going to have a certain amount of cost or expenses. And then here's my net difference. So under the current alternative, we have sales of $37,000 with cost of $14,000, the net $23,000. Under the new plan, we would have sales of $40,000 and cost of $15,000, their net being $25,000. So I can see the change is going to be net income of $23,000 currently will increase to net income of $25,000. Another way of looking at this is just take the difference. My new alternative has a difference of $3,000. That $3,000 is revenue. That new revenue would increase, and we're always thinking about what is my future income doing. It would increase, so I'm going to keep it positive. When I look at the expenses, old has $14,000 expenses, the new would have $15,000. That would be a change of expenses of $1,000, and that's change of expenses which would decrease my future income. Increase of $3,000 revenue minus a decrease of future expenses of $1,000, the difference would give me a change in future net income of $2,000, which says go with the new alternative. So that's what incremental or differential analysis does. It focuses on what is going to differ between the two choices, the two alternatives, and how does those differences change future net income. Whichever alternative or choice gives you the higher future net income, that is the choice or alternative you choose. So within this, the types of business decisions that you would see us using this incremental analysis is as follows. Special orders. And the special order would be that I'm currently producing a product for and I charge my customers a certain amount for that product, and I get a special order that somebody's willing to pay me usually less than what I charge my customers, and what I need to see is, will that new revenue that I'm generating cover any differential or any relevant cost? And we'll see more of that when we actually look at a problem. Make or buy. Should I continue to make my own, manufacture my own product, or would it be cheaper to have another company manufacture it and I buy it from them? Sell or process further, or what we call joint cost decision. We'll see what that is for that video. We also have what's called retain or drop a segment. Segment can either be a product, could be a division, could be a department. Replace or retain equipment, and then use of a constrained resource.